If you're someone who has their money in a checking account, a normal savings account, or just under your mattress, number one, you're probably not getting good enough sleep, and number two, you need to start having your money work for you. So with that, let's take a look at the 6 places you can have your money working for you, and we're gonna go from least risky to most risky, because you know what they say, more risk, more reward. So make sure to stick around till the end. The first place you can have your money working for you is probably the least risky and the easiest to get into, and that's a high yield savings account. A high yield savings account is a normal savings account, but where a bank offers a higher interest rate on your money that's stored there. And surprisingly, nowadays we're seeing pretty good returns on these high yield savings accounts, like 3, 4, even 5%, because we're in a high interest period. So just by keeping your money in the bank without having to invest it in any assets, you can get a 3 to 4% return on your money. And they can do this because they use your money that you store in the bank to lend to someone else at a higher interest rate. And because the interest rates and the mortgage rates that they're lending out are higher, they're able to pay you more into your pocket. So by using a high yield savings account and keeping your money in the bank, it's like you're lending the bank money and they're paying you in return. And saying it this way kind of makes it seem like it's risky, but don't worry. All money that you have in the bank is FDIC insured up to $250,000. So if you want to store more than $250,000 in the bank, number one, hit me up and let's make some business moves. And number two, you want to be splitting that up into different banks because the FDIC is only insured $250,000 per bank. There are 2 things that you absolutely want to have invested in your high yield savings account. That's number one, which is your emergency fund. An emergency fund is a fund that you put aside for 3 to 6 months worth of expenses in case anything was to happen. You have some money on the sideline that you can use. And then the second thing that should be stored in your high yield savings account is your sinking fund. A sinking fund is your fund that you're using on recurring things that come up. This way it's sitting in the bank account where you have access to it at all times, but at the same time you're getting a return on it with the 3 to 5% you'll see in a high yield savings account nowadays. The next type of investment where you can have your money working for you is bonds, and specifically treasury bonds. The concept of a bond is an IOU where you lend money to someone or whoever is issuing the bond. And in the case of a treasury bond, it's the government who's issuing this IOU. If I was to issue a bond for $1,000 with a face value of $1,500 and a period of 10 years, this means that if you lend me $1,000 today, in 10 years I'll pay you back $1,500. So that's a 50% return over the 10 years or 5% every single year. Usually the safest type of bond is the US Treasury bonds because you're lending money to the government, and as history shows, the government has always paid its debts. Well, they are trillions of dollars in debt. But, like I was saying, the government has paid its debt to its bondholders, I should say. The government will issue bonds that people like you and I can buy to pay for things like infrastructure, roads, military, and so on. And because bonds are more of an agreement rather than owning an asset where it can go up and down like in a company stock, they tend to be safer but have lower yields. There are also companies that issue their own type of bonds so they can lend money and pay you back in the future to fund things to grow. And these are usually rated on a scale of AAA being the best type of bond and a D being the worst type of bond. It makes sense to invest in bonds when you want something that's secure and predictable. You know that these bonds are going to pay you X amount in X amount of years. You don't really have to worry about them as long as they're good bonds. Now the next place to invest your money or have your money work for you is the third one we're going to talk about, and that's my favorite, which is index funds. Index funds have the perfect balance between the amount of risk they have and the amount of rewards they provide, and this is why I love it so much. Index funds and ETFs are both similar in many ways. They are both packages of stocks that will be grouped together, comprised of many stocks, and sold to you at an affordable price. Index funds will follow different indexes like the NASDAQ, which is technology heavy, the S&P 500, which is the top 500 American companies, and all the other indexes that you can find. And then ETFs have the same concept, but they can follow different sectors rather than the indexes. You can have an artificial intelligence ETF if you want to focus on that type of stock. You can have an energy ETF if you want to focus on energy stocks, and anything else that you can find out there. The great thing about these is the diversity within these funds. You're not investing in one single company here like you would if you bought individual stocks. With something like an S&P 500 index fund, this diversifies you over 500 companies. Now, these are more risky than a high yield savings account because you're actually investing in companies and not just storing it somewhere. But depending on the index that you choose, it could vary in risk. With something like VU or SPY, we've seen historical returns around 10%, which goes to show us that with more risk, you're going to get more reward compared to a high yield savings account, which gets you 3 to 4% on a good year. So it's simple to invest in these. You can just automate them every time you get paid. Just let the years go by and end up a millionaire just by investing every single month into these index funds. But the thing with this is it's buy no way a get rich quick scheme. So you have to be patient when investing in index funds. When to start investing into something like this is after you have your emergency fund and you're able to save up 3 to 6 months worth of expenses, because you want to save your future self rather than investing in the stock market in case anything happens. Similar to the last investment, the fourth place to invest your money is stocks. Yes, index funds include stocks, but stocks are more risky because you're buying individual companies and not spreading that risk over 500 different companies like you would with index funds. When purchasing a stock, you're buying a piece of a company, so you want to make sure you're buying a good company. Most companies have billions of stocks, so if you own 100, 200, even 10,000, you're likely not going to have enough ownership to decide how the next iPhone looks. Stocks are a lot more risky than the first three investments that we talked about because you have to know what you're investing in. If you put all your money in one stock or one company and that company goes bad, there goes all your money. So when investing in stocks, you want to make sure you're researching what the company is like, where their direction for the future is, what their financials are, and so much more. It's a lot more involved as well than the other three investments. When investing in stocks, the most important thing is to be patient because the market does have its cycles where it goes up and down and you don't want to be caught holding the bag when it goes down. One advantage with stocks over the other three investments is that its ceiling is much higher. You have potential to make so much more money than the other three investments. You have a high yield savings account and bonds around 3 to 5%. You have index funds around 10%, but you can see stocks go up 100% in 1 year if you're able to find that one company. Investing in individual stocks is definitely a skill and there is a big knowledge curve to it. So don't just go out there and buy every single stock hoping to hit big. Because if you're going to do that, just go to the slot machines. I'm joking, I don't advise gambling. Another big advantage with stocks is there's multiple ways of income with one individual stock. The first way of income with a stock is appreciation. You buy a stock at $10, goes up to $15, you sell, you pocket that $5 profit. The next way to make money with an individual stock is something called a dividend, or when they pay you out the company's profits. Like I said earlier, when buying a stock, you own part of that company, so in turn, you're owed part of that profit. Some companies will pay out a dividend, some won't because they'd rather put that money into research and growing that company even more. The fifth way to get your money working for you so you can become a millionaire is investing in real estate. Real estate is one of the most important ways to building your wealth, and that's why the majority of millionaires invest in real estate. Real estate has seen a tremendous boom over these last couple of years. We've seen house prices almost double since 2019. But on the other hand, we have seen times like 2008 where people lost their homes and the real estate market crashed, so this does make it riskier than the other investments. Other reasons why it's riskier than stocks, high yield savings account, bonds, index funds is because of things like a mortgage where you're going to have to pay that every single month. Sometimes if you're doing a rental property, you're going to have to deal with a bad tenant. Real estate is much more involved than the other option, but it does have potential to make more than the other options. So that's the bright side to it. Within real estate itself, there are 4 different ways of making money. Number 1 is tax advantages. Number 2 is mortgage pay down by the tenant. Number 3 is appreciation if your house prices go up. And then number 4 is equity build up. And then within real estate, there are different ways to go. You can go with flipping a property. You buy a broken property, you fix it up and you sell it for a profit. The next way could be buying a property, fixing it and renting it out and having cash flow every single month. And if you don't want to go into properties, you can invest in something called a REIT or a real estate investment trust. And these REITs are similar to stocks, but you're investing in a real estate fund where they use your money, turn around, buy properties, get cash flow and profit from those properties, and then pay you out a dividend in return. But one of the biggest risks with real estate is buying a bad property in a bad location. It's always said, you're not making your money when you sell a property, you're making your money when you buy a property because you want to make sure you're getting a good deal in a good location. Now the last one, in my opinion, is the riskiest one, and that's opening up a business. This is ranked last because it does have the highest potential, but it is also the riskiest one. But opening up a business could make you a millionaire, and if you're Elon Musk, opening up multiple businesses can make you worth over $200 billion. When opening up a business, you can start with something smaller and simpler like a lawn care business, a painting business, and other things. Or you can dream big and try to build the next Amazon. But obviously, one is going to be riskier than the other. Some things to account for when opening up a business is things like investments that you're going to need. Are you going to want to bring in other people to invest money with you? Are you going to want to hire a different team, or are you going to want to do everything yourself? But money aside, that's not the biggest risk when it comes to businesses. The biggest risk when opening up a business is your time, because businesses take up so much of your time. At the beginning, you're mainly going to have to do everything for this business. You're not going to have the money to pay other people. When starting up a business, you basically have to be the person who wears 50 hats and do the marketing, the accounting, the inventory, and everything else that's included. So it ends up being a lot more time included running this business than investing in something like a stock or just keeping your money in a high yield savings account. So from these 6 investments, like I said, my favorite is number 3, which is index funds and ETFs. And if you want to know more about index funds and which to buy and hold forever to become a millionaire, Watch this video next.